Hello everyone and welcome back to my channel. Today we are diving into a cornerstone of financial econometrics. I am Rupali Paul and in this video we are going to demystify the GARCH model. If you have ever looked at a stock chart and noticed that while price swings seem to come in groups, you have seen the phenomenon this model was built to solve. GARCH stands for Generalized Autoregressive Conditional Heteroskedasticity. It sounds like a mouthful, but essentially it's our best tool for modeling how volatility changes over time in financial markets. So let's get started. So why do we need GARCH instead of just using standard deviation? Financial data has modes. Specifically, we look for three things. Volatility clustering. This is the tendency for high volatility periods to be followed by more high volatility. And fat tails. Returns often have more extreme outliers than a normal distribution would suggest. And third is time varying risk. Risk isn't constant, it breeds with the market. By capturing these patterns, GARCH significantly improves how we calculate value at risk and how we price complex options. Here we look the formula of GARCH model, where sigma square is our current conditional volatility and W is a constant that is always positive. Alpha represents the Earth's term. It looks at yesterday's shocks or unexpected returns. Beta is the GARCH term. It represents the persistence of yesterday's volatility. To keep the model stable, alpha and beta must be non-negative, and we usually keep the main equation simple to avoid convergence issues during estimation. So the key concept here is long run variance. The long run variance formula is sigma square is equal to W divided by 1 minus alpha minus beta. This tells us where the volatility settles over the long haul. A critical tip for analysis. If the sum of alpha plus beta is very close to 1, the market has high persistence. This means if a shock hits today, the ripple will be felt for a very long time before returning to the average. One of GARCH's superpowers is forecasting. As we look into the future, the forecast eventually converges back toward the long run variance we just discussed. The speed of that mean reversion depends entirely on the alpha plus beta sum. For the model to be stationary, meaning it stays within statistical bounds, their sum must be less than 1. If it hits 1, we are dealing with a different beast entirely. Where do usually use this? We use uh, we use this usually risk management, asset allocation, volatility forecasting, option pricing, and high frequency trading. The advantage of GARCH model is we use it for risk management, portfolio management, option pricing, and stress testing. In risk management, it's vital for calculating variance so banks know how much capital to hold. In portfolio management, it helps in asset allocation by identifying high risk periods. In option pricing, since options are period based on volatility, GARCH gives us a more dynamic edge. In stress testing, it allows firms to simulate how portfolios react to extreme market shifts. Here are four limitations of GARCH model. One is symmetric shock assumption, volatility clustering, poor crisis performance, and normally assumptions. In symmetric shocks, it often treats positive and negative news the same, even though bad news usually spikes volatility more. In performance, it can sometimes underestimate risk during black swan events. In normality assumption, it may fail to fully account for those heavy tails if the underlying distribution is too extreme. So that's a warp on the GARCH model. I hope this helped clarifying how we track the heartbeat of market risk. If you found this useful, please like, subscribe, and leave a comment below with what topic you want to see next. I'm Rupali Paul, and I will see you in the next video.